Guys, hello. We're dealing with the North Star quarterly review and the videos relating to our funds for quarter 2 2026. We decided to do things a bit differently this quarter. I'm on the other side of the camera, not having to address the audience. I'm asking the questions, and we've got Donovan, Marco and Mark, each one heading up a different part of our business. Donovan looks after the full research function, Marco is head of South African equity, and Mark looks after South African fixed income or global fixed income. So we thought we would address all the pertinent questions that come our way constantly from clients and advisors today. So the first question is, I'm going to start with you, Donovan. On the offshore side, what has it been like this year, running money in the last quarter? How's the asset class, how's global done? And there's a headline kind of return, and then there's the nuances of what's really happened below the surface. Tell us a little bit about what it's been like facing the markets in 2026, the global markets, and in particular the last quarter.
Sure, thank you, Adrian, for that question. So yeah, 2026 has been a really, really interesting year and a challenging year for active managers managing global money. So Q2 has been an exceptionally strong quarter for equities, but the headline return really disguised the narrowness and divergence of that return, which made it difficult for active managers. So, I mean, it was very much a historical quarter for equities. The MSCI World delivered almost 14%, and emerging markets actually delivered 24%, so it outperformed that, with the S&P 500 delivering 15%. And actually, that was a record for the S&P 500. It was in the 93rd percentile since 1950, the return it delivered. So it was very, very interesting. But I think when you dig deeper, it was only information and technology that delivered 34% returns. And that was the only sector out of 11 that outperformed the overall market. And when you dig a little bit deeper within that, you see that semiconductors really drove that. And that was up 55%. And software lagged at 5%. So what you have seen is that there's been a very narrow market. And that narrowness has really permeated throughout the market. So you've seen that with style divergence. So momentum delivered 34% in the quarter compared to all the other styles, value, quality, and growth, which significantly underperformed. So I think that really speaks to the fact that there was a small number of AI winners that you had to be in, a handful, and if you weren't, as an active manager, you underperformed significantly. And I think that theme permeates through geography as well. If you look how divergent it was, you saw the emerging markets, Korea delivered 78%, Taiwan 49%, and that was really because they were exposed to semiconductors. When you look at the other emerging markets like China, Indonesia, they all delivered negative returns. So I think H1 of 2026 was really characterized by a narrow theme, highly speculative trading and momentum. And that was just evidenced by the non-profitable tech index that was up over 40%, momentum was up 40%. And I think that's overall led to bifurcation in the markets. And you've actually seen that in the S&P 500, 10 stocks accounted for over 60% of the return. Only 30% of stocks outperformed that benchmark, which is a very low hit rate. And over 30% of stocks in the S&P 500 delivered negative returns for the quarter.
Thanks, Donovan. So 70% of the stocks on the S&P underperformed the index.
Yeah.
Because you basically had a small grouping of companies drive the entire return with an abnormal return from a small group of stocks.
Exactly.
Almost like 2 or 3 standard deviations from the norm.
Exactly.
Yeah, very, very tough. And I would imagine, just briefly, that if you're a kind of valuation-driven manager, you would have been struggling to own those high-performing stocks in the quarter from a pure valuation perspective.
Exactly. I mean, and that also where the opportunity lies going forward for us is that you've had this dislocation in the market where price and value have diverged, and we remain disciplined, focusing on valuation and not trying to time the market.
Yeah. So Marco, the South African market, it doesn't have AI as a driver, but it does have platinum, and many of these things should benefit from an AI kind of environment, but they didn't. Did the opposite. So, what happened in SA, and what was it like trying to face the market here?
Yeah, so in Q2 in dollar terms, I mean, the market was back 1.7%, which compares quite incredibly with some of the, the emerging markets that we've seen. I think the emerging market, excluding China, was, well in excess of 40%. So, it underperformed in the emerging market sphere, but also, against the average, the MSCI index player. The story over 12 months is very different because it lies in between some of the performance of the MSCI World Index and the Emerging Market Index. Not as strong as the Korean equities, but not as bad as some of the negative performance that we saw. During the quarter, you had a bit of a reversal. Commodities were down 20%. Unusually, both energy and precious metal paired back. Basic materials was down 19% in rand terms. And at the same time, you had financials up 8% and industrials 4%. So, different reasons, but a bifurcation of performance in the South African context as well.
So if we understand that from the South African perspective, what worked previously, which was kind of platinums and golds, didn't in the quarter, and what suffered previously, which is industrials and less so in financials, have done well for quite a period of time, but the industrial complex suddenly did relatively well. So there was a change of momentum in the domestic market. But the kind of risk on trade certainly didn't help the JSE as a whole, because it was such a slither performance in one area, which is effectively the AI trade once again.
Yeah, that's right. I mean, and in our market, if you look at the various indices, they don't tell the entire story because the consumer trade was very weak. In the industrial space, it was very much the rand hedges that kind of outperformed. So it was very specific, some of the trades that went through over the quarter.
And there's maybe, just before we get on to fixed income, Mark, there is one common theme, and that is the cheapest parts of the market have struggled to perform properly, and the kind of super cycle trades, anything to do with tech, and that have actually been very strong. And or let's say the more expensive side of the market has been maybe a little different in quarter two in South Africa, but for the year it's been like you've had to be in the momentum stuff, the more cyclical stuff. There's generally kind of a cyclical bias to the way the market's behaved, and if you're focusing more on pure deep valuations, you're going to be sitting with a lot of plodders in your portfolio.
Yeah. So that's been quite a drag even to our fund, but at the same time a great opportunity. So obviously valuations don't close in the short term, but I guess even what Donovan mentioned, over the medium term, sanity does prevail most of the time, and a lot of these trending markets do kind of correct over time. So and what was perhaps a lagger could become quite a great opportunity going ahead.
I will say, if you think of Peter Lynch, who always said you buy a business, you don't buy a stock, but it feels like the market's been buying stocks as against businesses to some extent. And it is true, Donovan, that the AI trade has been enormously profitable. And we were just talking today about one company in particular, whose margins were supposed to be 8% and in one quarter doubled a semi. So the margins are being lifted and the cash flows are going in the direction of the semi. So, there is a rationality towards the way some of these stocks have repriced. But when you're seeing 200%, 300%, 400% moves in some of the semis, and 60-70% moves just in the last few months, and the market's perpetuating that kind of valuation into perpetuity, and the earnings expectations are very high, and that's kind of where we're quite concerned about things.
Exactly. So that begs the question that we're asking is, how sustainable is that? And history would suggest it's not sustainable. Economics and capital cycles says no. And it's an underlying risk that is seen at the headline level of the market that you don't actually see. So the S&P 500 is sitting at above average valuations, peak margins, and really that margin is being driven by the semiconductor index, which is now 20% of the S&P 500. It used to be 5 years ago only 5%, and a decade ago 2%. So as the AI trade matures and you start to worry more about monetization versus just throwing every money at the table, then you could start to see a wobble there, which would have a broad impact on the index, and that's why our portfolio should perform better in that environment, because we bottom up fundamental.
Thanks. All right, Mark, so just the fixed income space globally and domestically, relatively briefly, what have you faced in the last quarter and year to date? It's been quite a tough period, but fixed income's done very well at North Star, and I think we've navigated this extremely well. But just give us an idea of what's happening out there.
Okay, so sort of on the global front, I think what was the spanner in the works was obviously the conflict in Iran, and the subsequent spike in the oil price, which essentially the market needed to digest. And with that, you've seen US Treasury yields rise a little bit over that period. And then also the change of guard at the Fed. So Walsh coming in very hawkish. Really put a dampener on the global fixed income market. And then locally, it was actually the opposite. We've had an upgrade from Fitch, and so what we saw was something very South African specific. So you saw bond yields rally, and then also, so that's fixed bonds, and then you saw inflation in bonds also getting an added benefit with the pricing in of higher inflation. So you saw those yields come down quite dramatically. So those two aspects, interestingly enough, that also buoyed property. So local property did really well. So if you're looking at a mix of different assets for the balance fund in particular, properties did very well during the period. We unfortunately just haven't seen that translate into the equity space or in the interest rate sensitive equity space locally.
Great. So tougher period offshore for FI, quite a good period in South Africa, and as a whole quite a good period for our income fund, and we'll talk to that just now.